You are about to hear a story that could save you thousands of dollars, maybe even your entire life savings. It starts with a man named Tom. Tom worked hard for 20 years, saved every spare dollar, and dreamed of retiring early. One day, he got a call from a friendly investment advisor promising a guaranteed 20% return, no risk. Within 6 months, Tom's money was gone. The worst part, he didn't even know he was in a scam until it was too late. And here's the scary truth. Investment scams are more common now than ever. According to the Federal Trade Commission, people lost over $3.8 billion to investment scams in just 1 year. So, how do you make sure you never become the next victim? Stick with me until the end, because the last tip is one that even savvy investors often miss. And it could be the difference between keeping your money safe and losing it all. Number 1. Promises of guaranteed high returns. If someone promises you huge profits with zero risk, run. In real investing, every investment carries some risk. If an opportunity claims to give you guaranteed double-digit returns, that's your first red flag. For example, Bernie Madoff ran the largest Ponzi scheme in history by promising steady returns of around 10 to 12% every year. It sounded safe, but it was all fake. Real investments go up and down. If there's no risk, there's no real investment. Number 2. Pressure to invest quickly. Scammers want you to act before you think. They might say, "This deal expires today," or "only 2 spots left." That's not how legitimate investments work. Real opportunities allow you time to research, compare, and decide. One victim I read about was pressured into wiring $50,000 within 24 hours. The scammer said the price would go up if he didn't act fast. The moment the money was sent, the scammer disappeared. If someone's rushing you, it's because they don't want you to find out the truth. Number 3. Complicated or secretive strategies. If the explanation sounds too complex, or they refuse to explain how the investment works, that's a huge warning sign. Legitimate investments can be explained in simple terms. If they dodge your questions or say it's too advanced for you to understand, it's often because there's nothing real behind it. One example is a so-called AI trading bot scam. The seller said their software used proprietary algorithms that couldn't be revealed. Investors were told not to worry. The returns spoke for themselves. In reality, the only thing the bot did was drain their wallets. Number 4. Unregistered investments or advisors. Before investing, check if both the investment and the person selling it are registered with the SEC or your state securities regulator. If they're not registered, there's no oversight. That means no one is checking whether they're following the law. For instance, many crypto investment platforms operate without any registration, making it almost impossible to recover your funds if things go wrong. You can search the SEC's website or FINRA's broker check in minutes. If their name isn't there, that's a deal breaker. Number 5. Returns that don't fluctuate. Markets move. Prices go up and down. If your account statement always shows the exact same return every month, that's suspicious. Madoff's scam worked for years because he reported steady returns even during market crashes. But in real investing, consistency like that over long periods is almost impossible. If it looks too steady, ask questions. Number 6. Unsolicited contact. If someone you don't know reaches out with an investment opportunity, be very cautious. This could be a phone call, social media message, or even an email. Scammers often buy lists of potential victims and cast a wide net, hoping someone bites. A woman I spoke with once told me she got a LinkedIn message from a finance professional offering a rare chance to invest in overseas gold mines. She lost $15,000 before realizing the mines didn't even exist if you didn't seek them out. Think twice before giving them your money. Number 7. Fake endorsements or testimonials. Scammers often use fake reviews, celebrity endorsements, or even doctored news articles to appear legitimate. One infamous scam used deepfake videos of Elon Musk promoting a crypto giveaway. Thousands of people sent their coins, thinking it was real. Always verify endorsements directly from official sources. Number 8. Difficulty withdrawing your money. In a legitimate investment, you should be able to cash out according to the terms you agreed to. If you start facing excuses, your funds are locked for now, or you need to pay a release fee, that's a strong indicator you've been scammed. One man was told he had to pay a 10% tax before he could withdraw his earnings. After paying, he was told about another processing fee. Eventually, he gave up and lost it all. Number 9. Overly polished marketing. Scammers know presentation sells. They may have flashy websites, professional videos, and even fake offices. But good design doesn't mean good intentions. There was a case where scammers rented a real office for a month, staged investor meetings there, then vanished after collecting millions. Look beyond appearances. Verify the facts. Number 10. No third-party oversight. In legitimate investments, a third-party custodian often holds your funds. This adds a layer of safety. If the person asking for your money insists you send it directly to their personal account, that's a massive red flag. For example, many Ponzi schemes avoid using custodians because it's harder to hide fraud when someone else is monitoring the money. Number 11. Playing on emotions. Scammers are masters at using greed, fear, and urgency. They might say, "Don't miss this once-in-a-lifetime opportunity," or "If you don't invest now, you'll regret it forever." They know if they can make you feel something strong enough, you'll ignore the facts. One woman invested her entire retirement fund into a pandemic-proof business because she feared losing her job. She ended up losing her savings instead. Number 12. Complex fee structures. If you don't understand exactly what fees you're paying, you might be walking into a trap. Some scammers create hidden charges that drain your investment over time. Others use fees as an excuse to keep asking for more money. A common example is the maintenance fee scam, where investors are told they need to pay ongoing fees to keep their account active, even though no real account exists. Number 13. They avoid written agreements. If everything is verbal, you have no proof later. Legitimate deals are documented in writing, with clear terms and signatures. If someone says, "We don't need paperwork, let's just trust each other," that's your cue to walk away. Number 14. They target vulnerable groups. Scammers often go after retirees, immigrants, or members of religious communities. They know these groups may trust people who seem like one of them. Affinity fraud, as it's called, can be especially devastating because it feels like a betrayal from within the community. In one case, a church member scammed fellow members out of millions by claiming he had a special real estate deal blessed by God. Number 15. They promise insider information. If someone says they have a secret tip or exclusive access, that's often a lure. Legitimate investments don't require secrecy. In fact, insider trading, acting on non-public information, is illegal. Scammers use the idea of being in the know to make you feel special and lower your guard. Number 16. Too good to be true investments. At the end of the day, this is the simplest test. If something sounds too good to be true, it probably is. When in doubt, slow down, do your research, and ask for independent advice. Number 17. No independent audit or verification. Legitimate investments often have audited financial statements from independent firms. If an investment cannot or will not provide audited reports, that's a red flag. Scammers may create fake reports that look professional but have no real auditing behind them. For example, one fake hedge fund claimed massive profits but had no verified records. When regulators stepped in, the fund turned out to be nothing but smoke and mirrors. Number 18. Overemphasis on recruiting others. If an investment opportunity spends more time talking about how you can make money by bringing in new people instead of explaining the actual investment, it might be a pyramid scheme. Pyramid schemes collapse when there aren't enough new recruits to pay earlier participants. An example is when investors are paid from the entry fees of new recruits, not from any real profits. When recruitment is the focus, the business model is built to fail. Number 19. Fake regulatory licenses or certificates. Scammers sometimes create fake badges, seals, or license numbers to look official. They count on people not checking the legitimacy of those documents. One online Forex platform displayed a certificate claiming regulation by a non-existent financial authority. A quick search by investors could have revealed the truth, but by then, it was too late. Number 20. Excessive name-dropping. Some scammers try to win trust by mentioning partnerships with well-known companies or investors. If they claim a connection with a big brand, verify it independently. One scammer claimed his crypto project was backed by a major tech company. When journalists checked, the company had never even heard of him. Number 21. Only accepting payment in untraceable methods. Legitimate investments usually allow bank transfers or checks. If someone insists on payment via cryptocurrency, prepaid cards, or wire transfers, be cautious. These payment types are hard to trace and almost impossible to reverse. In one recent scam, victims were told to protect their funds by converting them to Bitcoin and sending it to a wallet address. The money was gone instantly. Number 22. Social proof from fake groups or forums. Scammers often create fake chat groups or online forums where everyone seems to be making money. They may show proof of earnings and happy testimonials to convince you, but these are often scripted and staged. One woman joined a Telegram group where dozens of people bragged about their profits from a new coin. She later found out they were all fake accounts controlled by the scammer. Number 23. They operate from countries with weak regulations. If a company is based in a country known for lax financial laws, your ability to take legal action is limited. Scammers pick these locations so they can operate without oversight. Always check where the business is legally registered and research the financial regulations there. Number 24. They avoid in-person meetings. Scammers often work entirely online or over the phone. If you request a face-to-face meeting and they refuse or keep delaying, that's a sign they might be hiding something. One investor said every time he asked to meet in person, the scammer claimed to be traveling for business or working overseas. Number 25. They copy real companies. Some scammers set up websites and emails that look identical to real investment firms. They might even use a company's real address and registration details. Victims believe they're dealing with the real firm. Until the money is gone, always contact the official company through verified contact details, not the ones provided in the suspicious email or call. Now you know the signs to watch for. But here's the part most people never hear. Even the smartest investors can be scammed if they let their guard down just once. The key is to make these habits automatic. Always verify, always question, and never feel rushed into sending your hard-earned money. So, what about you? Have you ever been approached with an investment opportunity that felt suspicious? What was the red flag that made you walk away?